This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. It is now 8 p.m. Eastern Time, and this is AJ Monty getting ready for the Open House Q&A, which is a monthly event that we provide for our subscribers as a value add, and helping those who would like a little bit more experience in reading the charts and understanding how to even forecast price swings and pivot points and reversals and all the things that go along with technical analysis. And this has been a very, very interesting market. And as you can see, this is the power shares, QQQ. In the weekly market report that I've been putting out, I have not been avoiding the Qs. I've just been trying to keep the weekly market report under a certain period of time so that we can get more people to watch it. When the videos get too long, we found that people tend to turn them off towards the end and not wait the whole way through. So I just kept it a little bit shorter. I analyzed the diamonds, the Russell 2000, the spiders, and the VIX. And with those things, we've been extremely accurate for 2016. And it's, again, my goal to help you be able to forecast with great accuracy as well. Again, this is a weekly 3-year candle chart of the power shares, which represents the NASDAQ market. And as you can see, we've been in an upward trend from 3 years ago, and we hit the high back on December. It's right around, actually that was November 30th. We hit the high for the NASDAQ, and then we pulled back with a fury. And what I'd like to do is point out a couple of things for you that are pretty routine in what I look for signals in the market. First of which are gaps. And if you notice back here with the NASDAQ, we gapped up. It's hard to see. Let me see if I could zoom in a little bit for you. It was during the time when we were, again, off to the races. See here, this was May 19th, the week of May 19th, and then we gapped up. Now, a gap is basically a price void that is usually the result of an overreaction to news, whether it be good news or negative news. In this case, this was a gap up. And I put out a web seminar for the Scotia clients who are up in Canada, and one of the strategies that I offered to them was gap trading. Is one of the very popular strategies that we incorporate here at the Market Guys. And there's a couple of rules that go along with gaps. Number one, 80% of the time, gaps fill. And what that means is if a gap is formed, there's an 80% chance that eventually the price will come down like it did back here. It came down, filled that gap. I'll even mark that for you. It filled the gap. And then the other part of the gap rules is that once a gap fills, there's an 80% chance that the stock will reverse from that point. And you can see over and over again there are gaps throughout this chart. Now, the interesting thing is that with the NASDAQ, 100% of the gaps that have formed over time, with the exception of just a couple that are left open recent history, but 100% of past gaps have filled. And so you got to pay attention to that, because here's one where it gapped up, again, very small. The gap is taken from the high on this day, which, what is it, on that week rather, the high was 108.32, and the low here, which was the opening more or less, was 108.57. So there's a 25-cent gap right here. That is a gap. The small gaps actually are a higher probability of filling than the larger gaps, by the way. So that's just small. That's a 25-cent gap. And then it filled, and then the week after that it reversed. And then look, there's a very small gap right here. And I really would love it if you do your homework and check any chart, any index, any even mutual fund, and you'll see that these gaps form all the time. And it's taken, again, from the very high of this day, which is 104.01, and the low here was 104.18. So there's a 17-cent gap right here. And then what happened? It filled here, went down a little bit more, but then again it reversed. Here's a gap down. And I'm not going to spend too much more time on this, but I want you to understand how important this is. Here is a gap down. The week of December 28th of last year was the low on that one right there was 111.51. 111.51. And the very first week of the new year, this year, it gapped down and continued to go down. Then there's a small little gap right here, so I'm going to mark that. There's a small, very small gap just by pennies. There's a gap here, and this gap, watch, that gap has filled. That gap is filled. So what does this mean? Remember the rules that I gave you. 80% of the time the gaps fill, and then 80% of the time after they fill, prices reverse. Now the price already reversed here after it filled, but there's an open gap here, and there's a minor gap right here. So when I'm doing my market forecasts, I pay very close attention to those gaps, and again, I look at the weekly chart, but then what I do is I'll zoom in to the daily chart. You can see the gaps will be more noticeable on the daily chart. You can see gap down here, see it? Now on daily chart, the gaps are still open here and here, here, and believe it or not, I think there's one way back here. Yeah, there is. Okay, so look at this. There are 4 gaps on the daily chart that are still unfilled. So if I were forecasting the market, I do take that into consideration. It's a very, very high probability that these gaps will fill. And then the other thing that I do, and I did this with one of our subscribers, I had a conversation about speed lines. What I do is I measure past up legs and down legs, and I look at the angle. So let's take this, and I'll take this low, and I'll bring it. Oh, I used the wrong line. I don't want a price line. I want a trend line. Hold on. Let me switch that. Delete that, and then let me go to my trend line. Okay. So I'm going to take. I'm basically looking at the angle of the move up. I can go from this low to this high. I can take the median range of that trend. I could do that. But if I take this low, go to this high, and I look back at something that'll take this low to this high, or right around here, you'll see that the angles at which the market goes up are fairly similar. The angle is very, very important, because the steeper the angle of the move, the higher the probability of a pullback. It's kind of like if you were flying an airplane and you give it full throttle and then you turn the nose straight up, eventually the plane is going to run out of momentum and pull back, because the engine won't be able to keep its lift. But I look at this and I say, that's interesting. All right, well, look at the angle of the most recent upward trend. This is, so far, the steepest angle that we've had in a long time. So there's a high probability that the NASDAQ is going to pull back. Now remember, this session is being recorded. I record everything. I want people to see the evidence. I don't want people to say, oh, you don't have a great track record. Okay, well, I'll tell you what. If you want to challenge me, I'll provide the evidence, and what we do, we record everything. You make the call after you've seen it. So after the market goes up, I also measure the speed of the downward moves. You see these? There's an angle. Here's another angle. You see that? I'm going to extend so you can see the angles. From this high to this low, boom, there's another angle. And because this angle was steeper than the other up legs, I'm forecasting that the pullback is going to be steeper than the previous pullbacks as well. So if I were to delete all these other speed lines and leave the most recent one that I've just used as a forecast, I'll leave that up there. I'll leave that as my forecast. That's what I think the NASDAQ could do in the short term. I don't want to erase all of them. I just want to remove that one. Okay. Remove drawing. Okay. So this is a high probability the market's going to pull back. So again, what I'm doing is I'm thinking out loud so that you can get into the same train of thought with regard to forecasting price action. So remember, I look for gaps above and below the market. I looked at the speed lines. I looked at the history of the speed lines. Sometimes I'll look at the cycles of the pullbacks. Okay, every pivot point has a cycle. I could say, okay, here's a low, here's a low, here's a low, here's a low. All right, so if I'm measuring those lows and the distance between the lows, I could say, you know what, out here somewhere, I'll probably have a low reached in this area because the timing of the cycle of these downward pivot points are, again, very much in rhythm with what we call cycle theory. Okay, so I look at that too. Then, finally, I take a look at volume. And by the way, folks, if you have a question, then please submit that to me. And Dylan says, would you call this a broadening top? You could. Broadening top is you see a higher high and you see lower lows. Yeah, that could very much be a broadening top, Dylan. Absolutely. Now, going to volume, look at this. Even if I discount this super high volume day and take the other highs, even if I take this high, connect it to this high, project out to this high, you can see that the volume is decreasing. Now this is critical. This is absolutely critical to your success with regard to forecasting the market. If you're not looking at volume in comparison to the angle of the trend, then you're missing the whole message of what volume means as a leading indicator. And so when the prices are going up, especially in a dramatic way, you need volume. You need the buyers to stay motivated. You need them to be pumping money into the market if, in fact, you want the market to go higher. But we're not seeing that. We're seeing the volume slow down. If the volume is slowing down, it doesn't matter if you're a buyer or a seller, money is not going into the market with any kind of force that would sustain this upward, almost vertical trading leg. So again, all evidence on the technical level is pointing lower. Now, on a geopolitical level, let me talk about something that's very serious. I just saw a news item. Now, this just came out about a half hour ago. This is from Associated Press. Now, this is an exclusive that documents are now showing less limits on the Iran nuke work, which is the agreement that the U.S. put together with Iran. And this is pretty scary stuff. This is all of a sudden the secrets of the document is starting to be disclosed, and I would encourage everyone to read this. Again, I don't have a political slant on this. It's a concern. It's a global concern. It should be for everyone. And the reason I point this out, among some other things that are going on in this world, for the life of me, I cannot understand how investors are feeling comfortable about pumping money into this market. It's like my 34 years of being in the markets is now telling me, it's like this feeling in my stomach. I can't even tell you. It's like a sixth sense that something is very wrong with the picture that I'm looking at on not just the Qs, but if you look at the Russell 2000, let me do this. I have to show you this because I made some forecasts in the Russell 2000 as well. These are resistance areas right here. And this is my forecast for Russell 2000. I said that we'd go up, test resistance. We did. This week, I put this little tag here because I think that we're going to start pulling back in the Russell 2000 because there's gaps, a very small gap here. There's a small gap here on the Russell 2000. And like the Qs, the Russell 2000 has 100% success in filling the gaps. And again, Russell 2000, along with the other indices, have very steep angles of their up legs. And so, again, I look at that, I take a step back, and I look at the weekly charts, and I say, okay, well, there's resistance. I know where resistance is. I take another step back, and I look at the 20-year monthly chart, and I see this right here. Can anyone tell me what this pattern is right here? Take a good look at that. Who wants to answer that first? I know there's a little bit of a delay in the chat box. But go ahead, type it in the question box. Okay, Sophie was the first one. Let's see if anyone else. Okay, Sal, you're correct. I don't know if anyone else could see what's popping up. I'm just going to name names. Jerry, Philip, Brenda, Larry, Herschel, Simon. You're all right. Every one of you typed in Head and Shoulders. Now, the reason this concerns me as a buyer, and I'll repeat that, as a buyer in this market or a long-term investor in this market is because we saw this pattern back here in 2007 and the beginning of 2008. If I were to cut this out and superimpose it on here, it would be almost identical. Left shoulder, head, right shoulder. Left shoulder, head, right shoulder. And it's really amazing, again, how reliable Head and Shoulders patterns are. So if we have any kind of a downturn in this market, especially the Russell 2000, I do believe it's going to trigger a major sell-off that will cause 2008 to pale, really, in comparison. I think that the next down move is going to be that severe. Now, I really hope that that doesn't stress you out. And the reason I hope it doesn't stress you out, because at the Market Guys, we can make money on the way down. We teach people how to make money on the way down. So if we see the setup here, Head and Shoulders, as compared to 2006, 2007, 2008, this is a 3-year Head and Shoulders pattern, as well as this. This started in 2014. It's going into 2017, coming 6 months from now. But this is a 3-year Head and Shoulders pattern that is significant. So if you have the investment instruments to make money on the way down, the bearish ETFs, the options, the inverse, even leveraged ETFs that are more bearish, then you can make a lot of money. Folks, I don't want to overemphasize this and get you all excited and then get you disappointed because you're not participating. I really think that this is going to be one incredible bear market coming up, and the people who are market savvy are going to do extremely well. While unfortunately, the people who are buy and hold, or even I could say buy and hope, those people are going to get caught in a bull trap. And they may not be able to get out, because you have to understand, when 2008 came about, right, it took 1 year from right here. Actually, I'll measure it. That's October of 2007. We hit that high. We hit the low in March of 2009. So we're talking a little over 2 years. But look at this. Mark this right here. Right here. Watch this. I'm going to mark that. It took 2 years to go down, but it took 3 years to make it back. You see that? It took 2 years to go down. See the dramatic drop? 3 years to get back to break even, and then it fell off after that. And then those people, it took it took them 4 years to make it back, because they didn't sell out back here. But my point is, when this one pulls back, it could take 5, it could take 7 years to recover, or maybe longer. I don't want to guess too far out, but when that next market move collapses and boom, everyone's left, with not knowing what to do, it could take that long. So at the very worst case scenario, I would say, even if you don't want to participate on the down market and participate in bear funds or options, at least be smart and know when to take your money off the table. to protect it. I don't care. Cash is king these days in my book. It's absolutely the best place to be. And you have to really make sure that if you're prepared, then you're avoiding a catastrophic loss. Now, Alan says if markets go down, gold, question mark. I'm going to get to that in a little bit, Alan. I will be talking about gold. Look at Philip says in 1929 it took 25 years to recover. Yeah, that is absolutely true. People don't realize that there were two crashes. Crash of 29 was the first one, then 34, same thing. In percentages, it was almost worse. So that's my spin on the Russell 2000. Now, I'm not going to spend too much time analyzing the markets, but I want you to look at the diamonds as well. And you can see, the newspapers are bragging about how we're setting a new high today and boom, boom, boom. But, again, this is a monthly chart, monthly, and look at the volume. This is a monthly chart. Isn't that incredible? We're almost at the end of this month, and that's just a little speck of volume right there. A little tiny speck. What do we have, 12 days left? There's no way this monthly volume is going to surpass what we saw in last month's volume in June. No way is that going to happen. And that's one of the most dramatic pullbacks in volume that I've seen in a long time, and you can see how steep this upward leg is right here. So when we talk about forecasting, I did that already in the market report. This is my forecast that went out on Friday. I said that we would probably pull back to test this roll reversal support. Former resistance back here, once broken, now turns to support. All right, let's look at the spiders, and then I'm going to get to the VIX in just a moment. Hold on, take a drink of water. I'm drying out here. Hold on. Oh, that tastes so good. Oh, fresh water when you're really thirsty, nothing better. Okay, thank you. All right, so here's the spiders. Same thing. That's my forecast. Gaps down below the market. A pullback to roll reversals is what I'm expecting. Now, my favorite. I talk about this every single week. If you're following the market report, then you already know what I'm going to say, but I'm going to say it again. This is, let me go back to a monthly chart of the VIX. I'm going to show you something here. In 2007, look at this. Right before the crash in 2008, look at this. Can you see the upswing? I'll zoom in here because you really have to pay very close attention to this. In 2007, the VIX showed a bullish engulfing pattern. Right before the crash, we had another bullish engulfing pattern. Now, the VIX is a contrarian indicator. At that point, the VIX, the low on the VIX was 1243. You got that? Right before the crash, the VIX was at 1243. Let's fast forward. Where is the VIX? The VIX right now, 1244. Now, that's the monthly chart. That's the monthly chart. By the end of this month, I believe that the VIX is going to rally. I believe it's going to rally. Watch. I'll show you what my forecast lines are. This is my forecast. We have a support level right there. That's right at 1243. Remember that low, this low right here, that's the same point where we were in 2007 before the crash. So if you get any kind of bullish indications on the VIX, you also have gaps above the market on the VIX. A gap here, a gap here. 100% of gaps fill on the VIX because it's an oscillator. It's not a stock. It oscillates. It goes from lows to highs, lows to highs. It's a measure of emotional volatility in the market. When investors are complacent, or they're relaxed, or they're just taking a ride, they're watching their money grow, but they're not putting any new money in the market, the VIX drops. When the VIX drops to these lows, that's usually a sign of a market high. I will bet my reputation that that support level holds on the VIX. I'm telling you, this is recorded. I believe that these gaps will fill. I'm that certain that they'll fill. And when they do, the S&P is going to start to turn lower. So the VIX and the volume indicators are going to be your best leading indicators. So make sure you're watching those all times. I don't care if you're in the market, out of the market, thinking about getting in or out of the market. This is something you need to monitor very closely, especially up until election 2016. Because, again, anything can happen. Craziness everywhere these days. And all it will take is some lunatic out there to spark a fear factor that will get to the investors, and they'll start moving out just for safety. And I hate to talk like that, but that's unfortunately the way the world is these days. Herschel says, can you buy the VIX now? The VXX is what you would trade if you want to go long the VIX. And that actually is a good indication. We do have, our subscribers do have positions in this and SDS already. Most of you are members, so you know that that's true already. So we're looking for SDS, which is contrarian indicator. It's an ultra-short S&P, that this will start to move up as well. I think that SDS could easily see 19, pull back a little bit, and then there's gaps all the way up here at 23.5. So thank you for that, Herschel. I appreciate that. And Alan, that would be an answer to your question as well. So Herschel helped you out with that. And Heinz, same thing. And Sophie, UVXY. That's not as popular as the VXX, Sophie. So I would stick with the VIX if you want to trade that one. Okay, now I'm going to change gears a little bit here, and I want to get to some housekeeping. I found that our Facebook page has not been as effective in getting the news out for our trade alerts. They're not as effective. And here, what is effective? It's the What's Up or WhatsApp app. If you do not have this, please go to this address right up here, WhatsApp, WHATSAPP.com. This is a free download. You can even download it to your computer. You can download it to a BlackBerry, a Windows phone, an iPhone, an Android. You can. And please, once you have downloaded this to your phone or computer, please let me know, because I am sending all of the alerts out, or notification that the alerts are going out, through WhatsApp. And sometimes we had a couple of trades, I think it was last week or the week before, where it was a contingent buy order, and I was telling everyone, wait for the green candle. We had a red candle. And this was a great tool that I was using to make sure people weren't getting in before the signal was showing up. So this, again, this is a free download. And once you have it on your phone, you simply add AJ Monty to your directory. That's all you have to do. And then send me a message, and I'll add you to the distribution list. Very, very simple. If you have any questions, or maybe you're still confused, send me an email at aj@themarketguys, and I will reach out to you. My goal is to get every one of our subscribers on this, so that when I send out the email, I could fire one blast out and everyone knows it's in their mailbox. And that way no one's missing any kind of trades. It's really, really great device. Okay, so that's all I'm going to say about that. Now I can close this out. All right, now my email address, again, David, is aj@themarketguys.com. aj@themarketguys.com. So once you're on the WhatsApp, even if you want to send me a courtesy email saying I'm on the platform, please add me. That's okay too. I'll reach out to you, make sure you're connected. And by the way, this application is encrypted. So for internet security, it's really, really good, because you're not going to get spam or anything. No one's going to break into your computer or phone or anything. It's really very good. Okay, any other questions about that? If not, I'm going to. All right, Larry says it works very well for me. Okay, good. Okay, this is our time where I ask for stock symbols, and I'll analyze those. Please let me know what your position is or what you're thinking about. Yeah, put your stock symbols in there. Okay, Ron says REXR. What is that? What's the last part of that message? Do not own. What would be a good entry point? Okay, let's look at REXR. All right, Rexford Industrial. Whoa, look at that. All right, folks, before I get to Ron's stock, I would like to invite everyone to take good notes, because when stocks like this pop up, it's worth looking at, number one, at least looking at, and I would make a recommendation that everyone put this on their watch list. Now, Ron, when you have a confused market like we do now, and then all of a sudden a stock like this pops up and it looks like just an uptrend that just won't quit, I think that it's fair to say that that's a good candidate for a watch list stock. I have to take a step back because I have to believe that this uptrend has not always been that way. Let's go back. Whoa. Okay, let's take another step back. I'm looking at volume here. All right. Here's what you got to watch out, Ron. How many green candles do we have in a row right there? That's probably 11. If I'm going to say that, I'm guessing 11. The angle at which this trend is, again, almost vertical, and we're seeing a drop in volume. Now, I like the stock. I like the trend. I don't like this is called a stale green light. It's a stale green light. This stock needs to pull back and correct, and chances are it's going to happen pretty soon with this one. Let me show you. Let's go back to the daily chart. I have to look at volume again. All right, volume is not holding up either. See, got volume is kind of slipping. Ron, here's what I would do. I would actually wait for this stock to pull back. And the pullback point is not going to be at a roll reversal. I'm going to draw the trend line. I'm going to connect this low and to this low, project out to this low. See how I'm doing that? And I'm going to forecast out. This is what I would say to do. Wait for the stock to pull back to the trend line and bounce. That would be a good entry point right there. And, you know, I could say, okay, just jump in there as long as the candles stay green, you're good. But, again, I take a step back and I look at the weekly and monthly, and this thing looks like it's getting a little tired. So I would wait for a pullback to the trend line, and then on any pivot point or bullish indication, that would be the place I would get long, because then I could put my stop right below the trend line. And that gives you a good get out point if, in fact, the stock starts to break its trend. But right now, again, that looks good. If you had it already, I'd say hold it and put your stop below this low. But I would wait for a pullback to the trend line, because you could see how the stock does have a history of pulling back to that trend line. You could see that the angle of the pullbacks are pretty consistent. You see that? Look at the angle of this line, this line, this line. It's pretty consistent. You can see that the cycle is they're pretty close in proximity as well. So we're probably getting close to a pullback, and that's what I wait for. So hopefully I helped you out. And then if anyone else, again, like I said, put that one on your watch list and keep an eye on that one. All right, now Ann is holding STZ. And let's take a look. Again, this is a daily chart. And what price are you holding it? When did you get in? And what price? Can you answer that for me? Let's see. I'll wait. I know that that'll pop up here in a little bit. It's a little bit of a delay. But Ann, if you could tell me where you own it, that would help me. In the meantime, I'll look for that. Now, remember what I said about gaps. 80% of the time they fill, right? And then 80% of the time after they fill, they bounce. So I think you're good. I think you're good to hold it as long as it doesn't break down below the support level. So if you own it, I would say put a stop at around 158. Okay, so you own it at 153. That's pretty good. You got a green candle today. But look at the volume. See, again, volume is dropping. The good news for you is that the volume is dropping while the stock is dropping. So that green candle is a very good sign. I still think it has a little bit more room to go on the downside. And you can see that when the gap has filled in the past, right? You can see when the gaps have filled in the past with this stock, it's bounced and reversed. So this is a good one. I'll keep it. And if you put your stop at 158, you're still locking in a profit on that one. Okay, next is Jerry. Jerry has AFL. He's holding the August 70 puts on AFL. Let's take a look. AFL. Jerry, I don't like buying short-term puts because you got time decay there that's affecting you, and plus you also bought out of the money puts. Now, for those who are not option traders, please bear with me here. You need the stock to actually break down below roll reversal support, and I don't think the stock is going to do that unless you bought the puts recently and you're looking to just take a quick profit by flipping the puts. Now, if that's the case, your get out point would be around 70, and I think this stock could very well pull back. So for AFL, again, that's AFLAC, I think that could pull back to 70, but it doesn't look like it'll drop much further than that, because you can see that the angle of these uptrends are pretty steady. This is a pretty steady one. So the pullback here will probably be a bounce and then a rally back into the market again. Okay, so hopefully I helped you out there. All right, now let's see. Philip is 100% cash, thinking about 1,000 shares of Microsoft. All right, now, Philip, to help you, let me say that remember what I just went over in the general markets, because Microsoft, MSFT, is going to be moving in sympathy with the market. Okay, so if you're 100% cash, this is a tough place to take a long position, because here's why. The stock basically is in a trading channel. You see this? And there's a gap up around 55.5. So you only have another $1.50 before this gap fills, and then what's going to happen is an 80% chance it'll drop. So I would say hold off on that one and look for a better candidate, because that's a lot of money to be putting in there when the markets are looking so toppy. And then if you look at Microsoft and they take a step back, because this is what I do, I call it 3D charting, you could see that Microsoft has a double top up here. And last time it did that, look, it's like a repeat performance. It would go high, pull back, another high, pull back, here a high, pull back, another high, pull back. And then what happened is, in the past, again, I'm looking at this whole thing possibly repeating, you have another third but lower high that formed after this last double top here, and that could very well be happening again. Again, this is a weekly chart, and you can see that the volume is dropping on the way up. And you have 4 green candles in a row. That's a stale green light. In the past, when Microsoft has had 4 weeks in a row, it generally pulls back. 1, 2, 3, 4, pull back. 1, 2, 3, 4, pull back. This was a long stretch, but then pull back. Then you have 1, 2, 3, 4, 5, and then the pullback. So I think this one's overdue for a pullback. You'll probably see that happen. If you get a bounce off of that, Philip, if you get a bounce off of 48, I would take a shot at that level. I'd rather buy it lower on support than try to buy it higher at resistance. All right, so hopefully that helped you out. All right, let's see. Sandy, I see you're a Scotia client up in Canada. I do focus mainly on U.S. stocks because we got some of the best liquidity, especially for options. And so, and plus, this platform that I have here does not go into the Canadian issues. So, I couldn't even give you a good recommendation of who might go up in Canada for recommendations. But I tell you, if you like, if you're not already a client, send me an email and I'll send you a couple of weeks. I'll send you a couple of free samples and see if you take that for test drive and see if you like it. Okay, Alan. All right, Alan, you got to my position, SLV. Now, I sold out of my SLV position entirely. Now, you all know that I was a heavy buyer down here. Oh, super heavy. I mean, I was loading up. I had my wife's IRA or retirement, everything in silver, and then boom, silver gapped up. And this is a weekly chart. I sold out of my whole silver position, 100% of it, and so you have a stop, Alan, at 1650. I would probably raise that stop. I would raise the stop to up here because watch, this is a gap. That gap is right around 1790. And remember what I said about gaps. I think silver is going to pull back. I think it'll fill that gap and then bounce. However, there's more gaps below the market. This is why I'm completely out of silver right now. And I don't like this. I've been trading silver since 1982. I've never seen so many unfilled gaps on the chart before. I actually have a buy order way down here for silver. So that's why I'm telling you, if you own it, I would raise your stop because if it breaks down below this support level, it's probably going to go all the way to fill the rest of the gaps. And again, 80% chance that it'll get a little bit of a bounce at this 1790 level, and then you could gauge your risk from that point. So hopefully that helps you out. Again, you're thinking of adding, be very, very careful of that until we see the correction and gap fills. All right, Nathan, GILD, no current position, he says. Let's see, GILD, no current position, but seems a cup and handle is forming. Yeah, I would agree with you on that. I would absolutely agree. Let's remove all drawings and let's wipe the board clean and draw over again. Now, for those of you who are not too familiar with trading patterns or price patterns, this could be what's known as a cup and handle. This would look like a little bit of a cup or saucer, and then it pulls back, with this being the brim of the cup. So Nathan, if you don't have a position in this, I think a good time to take a position would be a breakout over this, over that resistance line, because then you could put a target price up here for that gap fill. Until it breaks out over this resistance, this is going to hold as resistance and could very well drop lower. So you're in a good position, actually, not having a position, I mean, because if it breaks out, there's a high probability it will rally from that point. Okay? There's a high probability. And then once it breaks out, you have a place where you can set your stop. So resistance broken then turns to support. Hope that makes sense for you. All right, so that's Nathan. Okay, Ann, I got you. You put your price in. All right, now, Simon, we kind of went into VXX, and you were looking at TVIX. And let's take a look at that instead of VXX, and you say you don't own it. This is a leveraged VIX position. It moves 200% of the VIX. So listen, if I'm bullish on the VIX, I would be bullish here, but you got to be careful. This one showed up as a bearish engulfing pattern. So what I would do is I would wait for a bounce off of a newly established support level after this bearish engulfing pattern works out, and then I would wait and I would put a short-term target to fill this gap or this gap. Okay, this would be my preferred choice because it's the middle gap. So I wouldn't do anything until we trade out of that bearish engulfing pattern. Wait for a green candle. It could be a hammer pattern. It could be maybe a bullish engulfing pattern shows up after the bearish. It could be a harami. It could be a doji, a long-legged doji, especially if those are all confusing to you. Then just go to the Market Guys video page. It explains all those patterns that I've just described, and that should help you as well. All right? Thank you, Simon, for that. And let's see. David is looking for, I believe that's NVIDIA, NVDA. Yeah, NVIDIA Corp. Okay. Let's see what he says. Selling weeklies against a September 1650 call. All right, so you're selling, you're basically doing a calendar spread, I presume? All right, so you currently hold the July 22, excuse me, 53 short. I think that's a good one. I think that's a good position. I like those short calls against a longer call position. It's not exactly a long-term calendar spread, but you guys September against the weekly. I think NVIDIA has a good chance of dropping here to at least fill this short-term gap. Okay, so you got, the July. Wait a minute, the July. Oh, you got the weekly Julys. Okay, sorry, because we just had an expiration last week. Yeah, I think that there's a good chance that it's going to pull back to fill this gap. So I think you're good on the 53 call. So I'll help you out. Now, if in fact it goes higher, then just roll the 53s and maybe the 54s and keep the position. But it does look overextended because if you look at the volume down here, volume is dropping. See how the volume is slipping here? So that will help your short call position, but ultimately you got to be careful. It's a double-edged sword. It can hurt your September 16 calls too. I mean, the $50 calls, that's pretty close. You're more almost like a horizontal spread there. Yeah, but I think you're in good shape right now for that one, David. Hopefully that helped you out. All right, Simon, you got my attention on the TVIX, so hopefully if you got something else, go ahead, put it in. Unless you have another question about that, I'll help you. All right, let's see. Larry says, with foreign negative interest rates, buy more silver gold. Well, I talked about silver, Larry. GLD is in the same boat, actually, because, watch, you got the gaps. This was my forecast on gold. These lines are a little old, but you can see how perfectly GLD has fallen according to this. I think that GLD could wind up down here around 121. Gold and silver have these major gaps below the market. Once we clear these gaps out of the way, I'm telling you something, I'm selling everything to buy gold and silver. I am. I'm going to get extremely, extremely bullish on the metals. Especially what's going on with, with Britain. They're still trying to figure out this Brexit plan. I mean, this world has gone bonkers. I don't understand how the leaders over there could be bringing up all this energy to bring about a vote to exit, and then they don't have a plan in place. It's unbelievable, really unbelievable. So I think that will ultimately be bullish for the gold and silver markets. But again, we got to shake out those gaps. Okay. David, you have a bull call diagonal spread. Good. All right. Just you don't want it to go too much higher than what we talked about there. Okay, Antonio. Opinion on any stock that is due for a pullback but is going ex-dividend soon would be with a good dividend. Well, Antonio, I don't go in that direction because I'm not making general recommendations. That would put me out there as more as an advisor. I'm an educator / consultant / mentor / option writer. But if you have an individual stock that you would like me to analyze technically in front of the group here, I'm more than happy to do that for you. Okay, that's fine. That's absolutely fine. But if you have a stock. Okay, I have time for maybe 3 more stocks. If anyone has any more stock symbols, go ahead and submit those. If not, I'm going to take it on another direction, and I will just talk a little bit about more of the technical analysis things. Okay, no more stocks. So that's the first time. That's the first time. All right. So hopefully you took some good notes there, and you picked up a couple that you could add on your watch list. Now, let me just say this: when the psychology of investors starts to get into a place of confusion, let me clarify this, kind of like where we are now. When you get to that place and you start to read news stories about stocks that are the greatest investments, and you start reading Forbes, and you start seeing all these other stocks that they look like great buy candidates, you have to understand that there are analysts out there that work for the general public, and then there are analysts out there that work for the large corporations to help them push stocks. That's just the fact of life. And they got the sell side analysts, you got the technical analysts, you got the institutional analysts. Notice my charts right now, and please understand that I am doing my very best to embrace the simplicity of this market by not confusing any of you especially. There are no Fibonacci numbers on here. There's no Elliott wave being used. There's no Bollinger Bands. There's no relative strength index. There's no stochastics, slow or fast stochastics. There's none of that. None of it. I'm using plain, good old-fashioned candle charts. That's all I'm doing. Look, and my forecasts are extremely accurate, and all I'm doing is I'm analyzing candlesticks with volume. That's all I'm doing. Now, sometimes I guess you could say it might look easy. And it does take experience. It really does. I mean, I don't beat around the bush, and I don't tell anyone that this is going to be something that you're going to learn in just 2 days. It takes practice, practice, practice. And I've done this exercise with a couple of people, and I'm going to do this again. I'm going to use Sophie. I'm going to use Sophie here, and she gave me a symbol, J-O. Okay? Now, what I'm going to do is I'm going to ask everyone to close your eyes for a second. Just close your eyes. Close them. Boom. Close them for a second. I'll tell you when to open. Ready? Close them. I'm going to do an exercise with it. Keep them closed. Keep them closed. Keep them closed. Keep them closed. Hold on. Hold on. Keep them closed. Keep them closed. All right. Open them up. Okay, open them up. Now, what I've done is I've zoomed in to a stock that Sophie gave me, and I'll analyze this at the very end, Sophie, after all. And I want you to do this as many times during the week as you possibly can. It's an exercise. It's an exercise on how to read technical charts. Now, let's assume that this chart is today's chart. Don't worry, it's on weeks. It could be on minutes, it could be on years, it doesn't matter. I have it on weeks, but the technical signals are the same every single chart you look at, whether it be a minute chart, daily chart, weekly chart, monthly chart. Same thing. And what I'm going to do is I'm going to advance one candle at a time. But remember, before I advance one candle at a time, you have to analyze what you have on the chart already. We see here that there's a gap. Okay? I'm going to mark that gap. Hold on. I'm going to mark it with a horizontal price level. I'm going to mark that gap. I'm going to mark that gap. Now, if you were thinking about buying this stock, would you buy it today? If the candle all the way to the right, that red candle was today's candle, a daily candle, would you buy it, yes or no? Let's see. Okay, David, okay, David, Brenda. Okay. Well, you both got that right. All of you got it right. Why? Because it's a red candle, number one. Sellers are in control. And the volume is going up. You see that? Volume is going up. So the answer is no. So let me advance. Were you right? Boom. All right. You didn't win, you didn't lose. Let's see what happens. All right, went up. Big deal. You didn't buy. Now, I'm going to keep going. That long shadow right there, what does that mean? Does that mean bullish or bearish when you see a long shadow above the candle? Long shadow, bullish or bearish? Sophie, you're right. That's bearish. Let's advance the candle. Boom. Now, what is that? What is that called? We just see that candle. That's a bearish engulfing pattern. Okay. Now, there's a high probability that the stock is going to drop over the next 3 candles. High probability. I don't know that for sure. I don't know. I zoomed in randomly, told you to close your eyes. I don't know. But I'm guessing the stock is going to drop. Let's see what happens over the next 3 days. 1, 2, 3. All right. I was wrong. Let's see. Play it out. I'm looking for the gap to fill here is what I'm looking for, actually. Watch. There we go. Getting close to that gap. Close, no cigar. Now, let's look at this. Would you buy it? Would you buy this stock right now? First of all, none of you have lost money yet. We're analyzing the charts. None of you. Okay, gap above the market. Big green candle, high volume. I would probably buy that. Where would you put your stop? Where would you put your stop? Can you tell me what price? Anyone want to tell me what price you would put your stop? All right. The sell stop. Okay, so Nathan says 25. That's right on that support level. I would go a little bit lower. All right, let's go. We're going to play this out. The high probability it's going to go up. Bullish engulfing pattern, bullish engulfing. Oh, went down. All right, we got stopped out. All right. Now, what you do in this exercise is you basically trade with no money. If I was wrong on this green candle and I put my stop right below this level here, I didn't lose much money, but I did lose. And then what you do is as you progress, you continue to play as though the markets are open. Now, look what just happened now. This gap that I marked from back here has filled. That's what this line is. You see? Bearish engulfing pattern. Okay. So that's negative. You're not going to buy it. But what you do is you keep going. And you can do this on a daily chart, do a weekly chart. Actually trade. And if you follow the signals, usually it pans out a little bit better than what I just did. Remember, I'm doing this live. But what you do is you sit there and you just trade. Imaginary money, practice money. You can't lose money doing this. And particularly trade on the bullish and bearish engulfing pattern and trade the gaps. Gaps fill 80% of the time. This gap filled, this gap filled. If any time you were taking a short position down here, then you would have made money had these gaps filled, which are covering your shorts right there. You see that? So I say practice any chart. It doesn't matter what stock, what index. Practice. I like doing it on the intraday chart while the charts are going, actually. It's nice when you're doing it live. And to help Sophie out, let's go. She wants to know if it's a good buy here. Hold on. I would not be buying that one, Sophie. Here's why. You got a resistance high right there. You have a gap below the market here. You have another gap below the market here. And you have another gap below the market here. And as we've just seen, this stock fills the gaps. It's known to fill the gaps. So I would not be buying that until these gaps fill and you start to see a reversal, a pivot point from that gap. All right, so hopefully I helped you out, Sophie. All right, folks, that is 1 hour of Open House Q&A. I want to thank you. Please, again, as a reminder, go to the WhatsApp application. WhatsApp. Download that. Again, if you don't want to do it on your phone, do it on your computer. And that way, if you're on your computer, you'll know when the alert is delivered, and you'll be able to go to your email and get your alert. And for those guests who are watching for the first time, you want to sample that oracle, I'll give you a couple of sample alerts. Try it out, and if you like it, you just go to the Market Guys and you can subscribe. It's pretty easy. All right, folks, have a good rest of the week. Thank you again. We'll talk to you soon. So long.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for The Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, If you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.